So, good evening, everybody. Welcome to Keble's first home circle of the year. A round of applause. A round of applause. A round of applause. So, I'm super, super excited to be moderating this session today. My name is Deborah Akomolafe Joy, but you can call me Debbie J, and I will be your moderator for tonight's event. So today's home circle is themed Building a Resilient Property Portfolio for 2026. But before I move on, can we get where we're joining from? Can we put it in the chat box where you're joining from? Where you're joining from? Quickly, quickly, quickly. Time is not on our side. Are we shy? Oh, okay. Adeshola Ade from Manchester, United Kingdom. You're welcome, welcome, welcome. Beatrice Income joining from Abuja. Mr. Coco joining from Ontario, Canada. Super, super excited. That's really nice. The UK, Lagos, Obiageli Okoma, Lagos. Beautiful, beautiful, beautiful stuff. Thank you so much for joining. And yeah, just be rest assured that you would gain a lot from tonight's home circle event. It's packed with a lot of information, detailed information, and we hope that you get to take away tiny bits of what would eventually be a major contributor to your real estate journey in 2026. So beautiful one. Yeah, we'll be starting off strongly now by introducing our speaker. Amazing, amazing stuff. So now we'll be introducing our speaker tonight. I'm excited because it's about to give us loads of information, packed info, detailed info. So now a round of applause for the Chief Executive Officer and co-founder of Keble, in person of Jose Maria Aguilana. A round of applause.
Thank you, thank you, thank you. I was already gisting with my people already, so you like it.
Let me in on the gist now. What were you just about? Is it money?
We are talking about business that we'll try, and we are talking about the weather that
Eh,
Nigerian sports.
real, real,
See,
real, real.
that's a lot of gists, but don't worry.
I'll let you
Thank you,
now.
thank you. I really appreciate the intro. Um, Quick one. I can see everyone is joining from different places. Okay, Canada, Lagos, the UK. It's a testament to what we are building. It's also a testament to the kind of community we're creating here, which is a global real estate community. I'm very proud of the team, Keble team, and also proud of you guys as well that show up every single week or every 2 weeks that we have these sessions. Really excited. This year is going to be exciting for you and for me, right? Can I hear the amen? Amen. Amen, everybody. Amen. Lovely. Now, like I was mentioning before, the typical way that we have these conversations have always been around, oh, we're going to showcase property today, here's the structure of property investments, this is how it looks like, right? But today, we're going to do something quite different. We're going to do an exercise, right? Not physical exercise, or it's not exam. But we're going to do something special, something that have not been done before, which is Keble created a test, an assessment test, just 5 questions, right? And to help you know what kind of real estate investor you are, right? And today's conversation is focused on how we can structure it in a way that you will know what kind of investments can make my real estate portfolio more resilient, more stronger, right? And that is the core of the conversation today, right? So at some point, I would point to a link where you guys can fill, and once you fill it, to give you an automated response, and that will be your test results, right? So just 5 questions, very easy. You can do it in 2 minutes, right? So I'll share my screen to we're about to the screen. Okay. Okay. Can everybody see this? Can you guys see this? Can you guys see this? Just checking. Good? Okay, good. Fantastic. So I'll go to the next slide. So what is Keble? For someone that is new, how do you think of Keble? How is it structured in your mind? At the core of what we do, the Keble is a global real estate platform, right? Our core mission is to make sure that real estate is accessible to every Nigerian, right? And what we do on a daily basis is fairly complicated to explain, but like what drives us is how do we make home ownership, real estate accessible to everybody? Whether you're starting with your first 5,000 naira investment to if you're doing your first home mortgage facility, you're buying your first land, you're buying your first real estate asset, it really doesn't matter. And it also doesn't matter where the properties are located, right? Our core mission is to how do we drive that investment to the US, right, to the UK, right, and enable you to essentially build a global real estate portfolio, right? So I noticed that a lot of people are in the diaspora now, and you guys are in UK, Canada, the US, and you're thinking, hey, where do I put my money? What are the assets that I can invest in? There are so many assets in the world, stocks, the bonds, the mutual funds, right? Keble primarily deals with real estate, right? In the same way you're thinking of buying a Tesla stock or you're thinking of buying, an investment bond or treasury bill, like the core of Keble's foundation is real estate assets, right? So you're never going to see us sell, any other assets. This is what we do on a daily basis. But you are going to see a lot of offerings around real estate, and that's the core of it. We have a lot of partners. We have AXA Mansard, we have Mr. We've worked with ARM, we've worked with, Quantum Zenith trustees, and there are so many of them, right, that allowed us to build the portfolio for our customers on a daily basis. Today's conversation is about how do you build a resilient portfolio. I was speaking to a customer came to our office, it was yesterday, and he essentially said that I've been using this app for a while now, and he just wanted to see us. And we spoke at length, we had a conversation around investing, how is he thinking around it. And he's a very jovial man. Yeah, I appreciated the conversation a lot. But it's probably in his 50s, 60s at this point. I said, okay, I put in 5K here, I put in $10 here, he was just spreading his money around, invested in pounds and everything. But he wanted to do more, right? And he said, okay, well, I want to have a one-on-one conversation. And why was he interested in doing more? One, he wanted to solve the trust issue. So he wanted to know who we are. The second thing was that he was not clearly sure which one is best for him, right? So if I pick this one, we have land, we have investments, we have co-ownership, we have mortgage. Which one do you think is suited for me, right? And a lot of the conversation is really on that because everybody is different. Everybody has a different path to follow. Everybody has different capacity in terms of how much they want to invest in. Everybody's at a different age range. Some people are starting their careers while people are planning to retire, right? And one of the things that I'm eternally grateful for is we deal with customers across that spectrum. And most times, I don't really take it for granted. Especially when I speak to aged customers that are looking forward to the next 10 years, next 20 years, and they're going to be retired. And they're looking into Keble to see how we are building their retirement plan, right? And it's very important that if you're building your portfolio in that format for a long-term basis, you want to make sure that it is resilient, right? So this year, we're really going to focus on how do we drive that resiliency. So what is resilience? What does that even mean? Resilience is essentially saying that no matter what happens in the external environment, those externalities that happen, Tinubu wins, he doesn't win, doesn't matter. Nigeria falls, it doesn't fall, doesn't matter. Inflation goes to 100%, it doesn't matter, right? Essentially, your portfolio is built in such a way that it stands the test of time. And that is the goal of this exercise we're trying to do. So everybody is going to have a unique perspective to how they should build their portfolio, to how they should structure their portfolio, to how their portfolio will stand the test of time, right? Now, here's today's game plan, right? You're going to identify the real estate risk appetite. We're going to explore the offerings that Keble has, and we're going to see how you can build your own resilient portfolio, right? Again, even if you're not using Keble to build that portfolio, but this will give you an idea of, if I'm thinking of buying investments, right? I know who I am, I know my capacity, I understand the risk I'm taking, and I can execute based on that, right? Then we'll have a conversation, interactive conversation, to see, okay, what's my risk appetite? How did it go, right? How do we break that down even more for me, right? And we can have a separate conversation, one-on-one conversation on that front. And the last thing is that everybody walks away from this session knowing fully well what is built for them, knowing fully well what is structured for them, right? And you can essentially say to yourself that, hey, this is what works best for me, and I can build my resilient portfolio around that, right? So, is everybody here with me? Just checking. You can give a thumbs up. Let me be sure that everybody's still here with me. Good, good, good. Thank you so much for your thumbs up. Thank you so much. Right. So, Francis, can you share that link? Right. I will give 2-3 minutes, right, so that people can be able to take the test real quick. Now, as you take the test, I don't know, is everybody here on the community, on the Keble Tribe community? Is everybody here there? Let's check. If you're not in the Keble Tribe community, please indicate so that we would add you immediately, because we want to do something real quick. Okay, everybody's there? Okay. Beatrice is there. Okay, good, good, good. Real quick. Please, once you're done, you do two things for me. It will give you a result, right? That result, you see something on top. Let me explain real quick for you. These are the risk profile. I will explain them. So you see core plus, you see value add, you see opportunistic, right? When the result comes out, take a screenshot of it, save it for yourself. It is your own property. I don't even have access to it. It's your own property. Also share it on the group chat. Guys, just share it on the group chat and say, okay, this is my own risk appetite, right? Those are the two things I want you guys to do for me. I'll be waiting in the group chat to see what you guys are sharing. Thank you so much. If you're having any issues, please let us know. We've shared it in the chat, not even on the group chat. We shared it in the chat. Please, I only want people in this Google Meet to experience this. Right? If you're not here, you're not going to experience it, because this is very important. This is something you can take with yourself anywhere else in the world. This is something that you can take with yourself. If you're buying property, even in London, this would help you. Right? If you're buying property in the UK, you're buying property in the US, in Dubai, you will look at this and say, okay, who am I and which property suits me best, right? So as you're doing that, please Let's see. Let me know. Let me know. Okay. Has anyone finished? Let me be sure. Has anyone finished? Debbie, you too. Do your own test. Let's know. You're going to be the first person to tell me your own test self. I want to see. As you finish, just paste it on the group. No one is. It's not your account. It's not your account. But value add. Oh Lord, we are going to have fun today. Don't worry. Value add investor. Okay. I like that. I like that. I like that. Value add investor. Core plus. Okay. Please share your, because there's something I want to touch on. Once you share your the full page of that result, there's something we'll touch on. Right. As you share it, I would break down in detail what that means for you. Right. What that means for you. Good, good, good. So share it on the group. Let's see. Because there are some things that we'll be missing. Who else has finished? Who else has finished? Okay, good. Mr. Zico, fantastic. Take that test. If you take that test, you will know more about yourself than even Keble self. You will know more about yourself. Just once you take the test, fantastic. You will know. Who else has taken? Who else has taken? Okay, Francis said that he has taken Core Plus. Okay. I can't access it. Kept logging me out. Oh my. Can't seem to access the test. Okay. You're seeing that. Okay. Target portfolio. Good, 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 good. Okay, fantastic. If you're trying with you can try with a different browser if you're having issue, right? But this is the risk assessment test. Try with a different browser. I want to see if I can get at least 5 people that have done theirs, right? 5 people that have done theirs. We know that we have 5 people that have done theirs. Fantastic. We can push. I've done theirs. Can push. Debbie, Core Plus. Core Plus investors. Okay. That's good. That's good. Core. Chika, your core. Do you know what core is? Hey, okay. Core. I want to see someone that is opportunistic. I want to see someone that is value add. Okay. Value add. Okay. Good. I like that. So how many do we have now? Can someone tell me how many we have now? I think 1, 2, 3, 4, 5, 6. Okay. Please, if you're having any issues, try with a different browser and see if it works, right? Because I think I tried with a corporate email or a corporate account and it wasn't working. But when I tried with a different account, it worked. So maybe that might be your situation. It could also be network, right? Because the link is the same everywhere in the world, so it doesn't change. Okay. Let me see. Okay, 6 people. Okay. Any other person? Should I wait for some people? If you want me to wait for you, just let me know. Okay, Core Plus. Okay, good. Please take a screenshot of that. So don't lose it. Too. I'm begging you. It's not for me. Oh. You need it. It's not for me. Yeah. So 7 people. 7 Core Plus. We have a lot of Core Plus people. I love that. Okay. So nobody is opportunistic like this. Okay. I love it. Okay. I think we have 8 people. Value add. Okay. Value add. That's good. That's good. That's good. That's good. I think I can move. Permission to move. Thumbs up if I can. If I have permission to move. Ah, okay, good. Good. Wow. Okay, good. I think I'm good to go. I'm good to go. Thank you. Thank you so much. Thank you so much for taking this exercise. Right. Um, there is something important. Not right. Is now this is the answer you've gotten. Uh, yeah, I like that statement. Age is a factor too. Good. The answer you've gotten, right, is a guide, right? And that guide enables you to know yourself as an investor, understand those investment terms, and understand how it pertains to how you're going to be investing in real estate. Now, I know that none of if we've done something similar to this with general investment, you see situations where you say, okay, are you a moderate investor? Or are you a aggressive investor? I've forgotten the terms. Or conservative investor, right? Someone has found opportunistic. Hey, Dele, is it your score? If that's what you think, let's know. Let's hear from you. I want to be sure is what you found. Dele, is that you?
That's what I found. That's my
Ah,
score.
fantastic. I
Hello,
can
can you
hear
hear
you. I
me?
can hear you. Fantastic. Okay, okay.
Yeah.
I like that. I like that. Okay. I was looking for one opportunity so that we cover every area. Okay. Thank you so much. Thank you so much. So this is pertaining to real estate. Anyone that have done anything professional in real estate, and these things they teach it. Maybe you see people that maybe have done estate management. Hopefully, they've taught them this. But anyone that is in finance in real estate, right, should know this, right? This is the foundation of how capital is being deployed, how large capital is being deployed. So whether it's large or most professional property financiers will use this framework. And that's why I say it's a global thing. But what we want to do is to make it personal to you so that you can use it as your own tool to invest in property, right? But first of all, what are these terms? We are using all of these, will I say, jargons, finance, real estate finance. What do they even mean, right? The first thing, we're going to talk on core. So core people, if you know your own is core, not core plus, so you know that it's core plus. Core people, you like your major focus is I want to protect my capital. If I'm not looking for high return, self, you get if the return is giving me 1%, I can sleep at night. So core people are focused on capital preservation, stable, consistent income, and minimal risk, right? Minimal risk. That is what core. So they are the lowest of the risk. When I mention risk in this conversation, I mean in relation to, not in absolute terms, right? Everything here, when it comes to investment is risky, right? I'm a financial investor, investing for years now, right? And there is no whether you're investing in stock or whether you're investing in bond or everything. I've seen bond collapse, I've seen stocks collapse, I've seen government bond collapse. So nothing is easy. I've even saving self. You see, all of us have seen banks collapse. So what we are talking about is risk management, right? So when you're in core focus, you're focused on low risk, minimal risk, right? Now, you move over to core plus. What is core plus? Core plus is moderate risk relative to low risk. So core. So you're willing to do certain things that core people would do, right? You still have the same goals as core people do, but you're willing to move a little more to the risk area. You need to touch that ground for the focus of growth, because the core people are not focusing on growth. Nothing concerns them with growth again, right? Where I've seen, in terms of my own experience, where I've seen people focus on the core side, they're mostly people that are retirees. Their aim is not to do much, right? Their aim is not to find 200%, right? They might not live that long to even see the 200%. What they want is the cash. They're looking for cash. They're looking for something that this is my gratuity from the pension that the government have given, or from my pension provider have given me. I just want it to be there, right? So that it will be yielding something for me, right? So that's where the core plus people are. Anybody that is older, that is thinking of this structure, there's a certain investment that if you speak to us, right, would show him, right, at that age, right, or at that time in his life. It really depends. Some people they've done a lot and they have a lot of capital, or they don't have so much capital, but they tilt more to the low risk side. It's possible to give them certain investment opportunities in real estate. The next thing is value add. Now, where you see value add is when people are trying to improve an asset. So when you hear things like these people bought this property at a discount, they bought it for 2-bedroom apartments and they converted it to 4-bedroom apartments, that is adding value, right? When you're buying assets during the construction phase, which is most of the time, this is what happens in Nigeria, right? Most of the assets, construction, that's where people would buy, right? Now, in the value add, there's a lot of active management. It's not passive, right? It's not a passive thing at all. You're trying to, and that is where Keble plays a lot in the value add. We started off as value add. We know it's a moderate risk assets investment strategy, but that is where we play around, mostly where we play, right? Is the improving of the assets. When we were doing stuff in the US, it was improving the assets. You buy it at a discount, you refurbish it, you repaint it, you sell it off, right? Or you rent it out. Same thing in the UK. I was looking at a deal in the UK, and it's simply that, okay, they're trying to convert an existing the family home and convert it into a student apartment. So they are breaking off a lot of the rooms and restructuring it so that a lot more people will live in that area or in that building or in that apartment, sorry. And you can make money from there, from the rental income. So a lot of the value add risk investments or risk investors, you're going to be seeing you trying to improve something, trying to add more value. That's essentially is to add more value to it, right? Share with me. Then there is the opportunistic guys, right? So when you hear opportunistic, what do you think? I don't know whether you guys remember when people were saying, we have buy land is close to Dangote refinery. I don't know, you guys can do thumbs up if you remember. Buy land in Ibejuleki, Dangote refinery. That is you're selling an opportunity. I don't know if you guys remember. You guys remember? Those people have made money. I don't know. I know people personally that have made money in that buy land in Dangote refinery side. I know, right? So when you hear things like that, it's an opportunistic thing. Nobody, even actually, I went to Ibejuleki late last year. You can't. I don't know who is living there, but they're still selling land there, right? But they are selling a dream. They're selling an opportunity, right? And every developed area, whether it's Ikoyi or Lekki Phase 1 or Lekki Phase Aja is the one I've seen in my own in my own lifetime here in Lagos, right? It is, I saw Aja when it was not, but now the property I'm seeing in Aja is even better than even Lekki Phase 2, Lekki Phase 1 area, right? So the opportunistic side of it is very high risk, right? But it also has high reward, right? And you're essentially speculating that because everybody's saying when Dangote refinery open, the land will boom. Are you building the Dangote refinery? Are you Dangote? Right? Is you that? How do you know that refinery will open? Yes, that's open though, and glory be to God, we're happy. But you don't know. So you're hoping that when Dangote essentially has the capacity to do it, your land would increase. Abi? That is opportunistic. So they focus on high risk. Right. Okay. Now, we're breaking things down now. So let's focus on core. Like I mentioned earlier, you will see the focus is on capital preservation and steady rental income. Now, for people that don't know, when it comes to rental income in Nigeria, it's pretty much 5%. So let's say um I bought a property for 100,000 naira, right? 5% of it is 5k, right? So every year you're getting 5k from that property, right? And when you're thinking about it, the person that is at the core doesn't really care. He just wants to know that his 5k is coming. Do you get anything that happens to that 5k? That's his business. Now, this type of investments, they work well when there is a steady economic progression and when inflation is stable. Now, people that do core in Nigeria and only focus on steady rental income, right? They tend to not, you see conversations like, hey, I'm not making as much money in real estate because of X amount of rental income coming in. I don't know if you guys remember 2 years ago, it's not even far, 2 years ago on Twitter, everyone was saying, if I use my dollars to buy, I bought with my dollars 5K, I bought land. How much is it in Naira? They were converting it, right? I bought one building. How much is it in Naira? They were converting it, right? How much am I even making in rent? They were converting it, which is valid. You obviously you want to know in relative terms, has this investment done well for me? Valid. What landlords will now see is that, okay, oh, it looks like this investment is not working for me. So let me increase the rent. Now, everybody in the last 2 years, my brothers and sisters, the average rent in Lagos has gone up by 50%. 50%. I don't know whether it is what is going on. Normal rent, this is not even Airbnb. Normal rent, on average, you're seeing 50% growth in normal rents where people go and sleep. So you're seeing that it's not, oh, it's not a, um, it works well in areas like the US, in the Western world, right? Core is really, you know that, oh, inflation doesn't eat my capital, right? Economic situations doesn't, well, I say currency fluctuation doesn't eat my capital, right? And I have a steady, you see in the US, you see someone getting 4 or 5% in rental income. That is a good deal. That is a fantastic deal, relatively, right? If you do 4 or 5% in Nigeria, right, it is so low, to be honest. It is so low because you can't even compete with the inflation rate. I don't even know what the inflation rate is now, today's terms. Ever since they rebased, I've stopped keeping tabs with inflation rates, right? But that is where core is focused on, right? Now, the risk minimal. So, what kind of properties do you think we will see in something like this? One, it is already built properties that already has rental income. So it's not that it's built and it's empty and you're the only person coming in. It's built. You know that it's built. You already know that there is a tenant there waiting for you, and cash is coming in. People don't understand what that means. Some people think that core is when you just go. It's you that use your hand to find tenants, or you take a couple of months. That's not it. People are already coming in and buying the property. The tenant does not know that property has changed hands. All he knows that he's paid to a different account, right? That's good. That is where core is focused on. So assets already generating cash flow, already built. Those two components need to come together, right? And you see certain large capital providers focus on the core. So you see people like REITs, pension funds, right? They play in this area because it's predictable, because it is structured, because they can forecast, right? Right. The issue is that in Nigeria, whenever I keep saying that when it comes to Nigeria, economics turns upside down. Right? The way economics, if you're an economics major, whether in BSc or whether you did masters, you will know. Because I did 2 courses in economy. I did microeconomics, I did econometrics last year. Whenever it comes to Nigeria, the lecturer tends to just say, "Don't worry." You tell you that, "Don't worry, it's Nigeria." Nigeria economy takes its own shape, right? So it doesn't really work well, but it exists, right? Okay. Please, I don't know if I'm making sense. You can give a thumbs up so I know that you guys are with me, right? Good. Core Plus. I can see a lot of people in Core Plus. Core Plus is a lot more realistic for Nigerian investors, right? So the focus here is growth. There is growth, right? Anybody that bought into the traditional home ownership side, especially in Nigeria, where most of us are buying off plan, you're in Core Plus, right? Anyone that have bought into the co-ownership structure in one shape or form, you're also in Core Plus, right? And the mix of both is where the unique value proposition comes in, which is you're not sacrificing cash flow for capital appreciation. You're essentially trying to strike a balance between capital growth, right, and cash flow. And when it comes to the structure of it, you tend to do more minor improvements, right? There's a deal we did early in 2020, and the developer bought a property, and he bought the property. It's already fully built. He needed financing to furnish the area, right? That is a typical minor improvement, just paint here, paint here. It's not changing anything structural, right? But that is where Core Plus is focused on. So you see a lot of it with, okay, I bought this property, maybe it means it needs more painting, maybe I need to fix the roofing, stuff like that. But like there, you're trying to make those improvements. Remember, you're making those improvements not for the sake of capital preservation alone, because that's where Core Plus is, for the sake of capital preservation and also cash flow, right? You want to, in a situation whereby you have a mix of both. That is where Core Plus is. Are we good? Okay. Someone is saying it rained here. Network is unstable. I'm not sure. Well, okay. Don't worry. Your result is opportunistic. Don't worry. We're getting to you. But that was my result. Okay. Don't worry. Thank you so much. Thank you so much for sharing. Value add. A lot of people are also in value add, right? So what is value add? It comes from you already see that is where you add more value, right? So this is where you do a major improvement in the property, right? So things that you're buying, you see when you buy properties when it's still foundation, right? When it's still carcass. Carcass is where they've not painted anything. You're still seeing the bricks in the wall, right? You're buying property. I don't know. Do you guys remember LD? Back this. It's not for Gen Z people. Gen Z people will not know who LD is. Do you guys know who LD is? LD, one rapper. Is it everybody that is Gen Z here? Please, people should. Okay, fantastic. Gen Z people. Sorry for Gen Z people. So LD is after he finished his career in music. He traveled to the US there, and I was watching a video of him talk about he's a real estate developer in the right, and I was watching a video. My guy, I was watching a video of him talking about one of his strategies that he's doing, that he turned, I think, a 2-3 bedroom into a 5 bedroom, right, apartment. And when he turned that property into it, he realized a lot of equity value. So the property was worth maybe $250,000. Instantly, it's now worth $500,000 or $450,000. Right? He can take a loan from that equity and go to the next property. But the other thing he also mentioned was that because he improved that property, the rental value of that property also grew. So instead of him collecting rent from 2-3 places, he's collecting rent from 5 places, right? So you're seeing that, right, as a core value, a value add that he's putting in, right? So where do we play? You see a lot on the co-ownership side, right? So that's where we play into. You see a lot of the fixed income investment as well, because of certain fixed income investments are also playing into that value add, right? And the focus of it is just a lot of it is actually higher returns, right? Whether it's rental or whether it's capital appreciation, the goal of this, the person just wants to make more money, right? And essentially, you want to make above market rates here. So if the market rate is giving you 10%, 18%, here you're looking at how do I make 20% and above? What's the structure going to look like? That's where the value add comes in. So here is like you're searching for higher returns because essentially you're improving the asset to get a higher return. Good, good, good. Now, the last part, opportunistic. I want to check the time. Okay, we're still in session. Opportunistic. When I mentioned earlier that back then, I don't know the year, but I think 2019, 2020, right? They'll be saying buy land in Ebel, buy land in Bejilekio, Dangote refinery is coming, right? You see the what's it, the second international airport, right? They'll mention it. You say, okay, I need to buy land in this place. So good. It's almost similar to what's happening now in Ibadan, right? A lot of it is actually opportunistic. It's just that maybe it might not be so opportunistic, but yeah, I would still consider it as an opportunistic investment because they are using certain traits that we've seen in Ibejuleki to actually attract investors to buy. And it's not saying that it's a bad thing. It's just saying that the focus here, you tend to think more long term because it's not going to happen in 2 days, right? It's not going to happen in 1 year. I've never seen any opportunity investment materialize in 1 year. The most I've actually seen, is actually 2 years. So close to 2 years, 18 months time frame, right? So you see that the focus here is on higher reward, long-term speculative play, right? The risk here is high. There's no really anything that's to it. It's just high, right? And because it's more long-term focus, there are certain things that can happen along the way, right? That you have to accept the volatility, right? So for instance, I'm sure that when people bought the Bejuleki land, there will be times where they felt like, I'm gonna be like, say this Dangote refinery will not show, right? And they'll sell it off. Another person will come and buy. And there'll be times where you feel like the government will never allow this to go through, or the cabals will not allow this to go through. And you're like, I'm not so confident in this, my strategy. And you sell it off, right? There are also sometimes, even in 2020, people say that real estate doesn't dip. It dips, so, right? It just doesn't dip the way it dips in the West. It dips for a short period of time. In 2020, we saw dips in land ownership, especially during that COVID period. We saw a situation whereby within that 3 months timeline, yeah, asset prices just people were willing to sell at a discount, right? To just go. And that's what dips prices. If your neighbor is selling at 2 naira and you need 1 naira, you sell your own at 1 naira, you sell it sharp, sharp, right? Your neighbor will see that you sold your own at 1 naira. This one said, you know what, let me sell it at 1 naira too. And you see that asset prices sort of go down, right? When you're thinking about opportunistic investment, you're thinking long term, right? So it's not 1 year. In fact, I would argue that it's a 10-year strategy. Just know that I bought this land and I move on. And that's why I think last year I was seeing a lot of news of people that have held properties, land for 10 years. You buy it for 2 million, you're selling it for 150 million, and you're wondering, how does people say, I want to buy land, I want to buy land. Yeah. You say, that's how I bought a land in a bed. Is this, I'm seeing 200 years ago, sir. I want to be sure that we are not with seller or someone. Is this the correct years that you measure, or is a typo? Let's know. Close to Atlantic Hall School. Should I go as? Okay, 20 years. Okay. I want to be sure. I bought a land in about 20 years ago, close to Atlantic Hall. Should I go and sell? 20, okay, like 20. Oh, okay. Just wanted to be sure. Yeah. I mean, again, like for you now, I'm sure that you bought it, it's not the price of today, right? And you can sell it. I'm sure a lot of people are willing to buy that land, right? Because as Ajay is opening like this, and the Bejodeki is opening, the Bear is also opening as well, and people are seeing value there, right? So yes, I think it's feasible. So what is Keble Fit? A Keble Fit is saying, okay, there are opportunities there. There's flexible land that you can pay. We have options where, and that's the beauty about Keble. We decided that last year that if you're buying Keble, if you're buying land from Keble, you don't have to put the down payments. You can, we have that option. You can even pay it outright. But we created an option where you can even spread it for 3 years. Right. And as the price, I've seen someone that is paying for a land, he paid for 6 months. I think the total amount he paid for in that 6 months period is around 1.5, right? But as he was paying for the 6 months plan, the property has appreciated so much that the price that he's buying at 1.5, the current price is 3 million. So if he decides to sell it today, he's selling it at 3 million. It's essentially doubled. I'm not saying that happens all the time, so that people will not go and hold me, but that is how we want to create some level of level playing ground when it comes to real estate investing, right? There are options there. Now, we have options like traditional home ownership, is what people do today. We have co-ownership, we have fixed income. The difference is the intent, right? What is the intention behind it, right? And sometimes we write it in the description. Say, okay, this asset is for this. It's for this. It's always in the intention of how we deploy the capital, right? So when you're thinking of even Declan, there's a thesis behind, okay, why we picked Declan, why we picked Buckingham, right? A lot of this is also value add and opportunistic in its own way, and that's where the value comes in, right? So yes, so Keble's real estate investment products, right? So if you're in any of this stream, you're always constantly battling with, okay, what's the combination, right? Like I mentioned, this is an absolute term. This is, in a way, you're looking at it in absolutes. But I've seen fixed income deals do co, right? Just that the returns in this framework, you're sort of mentally, you're thinking of, okay, I'm only focusing on I'm not even focusing on income, I'm not focusing on returns, right? Fixed income is slightly, for those who have invested in any of our fixed income products, is like 20% and above, right? So you see us play around core plus value add a lot, right? Traditional home ownership. So this is the home ownership that our parents are bought into. That's, when we want to buy property and we just want to rent it out, right? This is where it's focused on, right? But I've seen some traditional home ownership structures that can also go with opportunistic. So you're seeing I was speaking to someone today and they bought a property in Awoyaya. That's above, going past the Shangotedo side, right? After Aja. So you're going to see, and I asked him, like, is anybody living there? I'm very curious. Like, whenever I'm trying to invest in some of these things, I'm always asking, are people living there? And they'll say, yeah, people are living there. Like, what's the demand looking like? Is the rent selling out, or do you have like empty spaces, right? But here you're just focused on, I want to preserve my capital, right? So core plus people, when they buy, I want to preserve the capital. Maybe I need to make minor improvements to this building, right? Maybe I'm focusing on the outskirts of the location, but I know that if I buy this property for 20 million, 30 million, right? I know that in some way, if Dangote opens another refinery in that location, I'll be able to sell this property at X value, right? So it's possible, right? There's co-ownership. What we currently do now, a lot of it is value add and opportunistic. A lot of it is focused on that. Again, like I mentioned, we play in the value add space, right? It's our bread and butter. We understand the metrics that we're looking out for. We understand the risk, right? So a lot of it is actually playing there. So the co-ownership is focused on, like, it's less opportunistic. Most of it are really solid takes. Like, we don't go into the bush, so because it's shortlets, and we already have a situation whereby people are already doing shortlets in the area. Businesses are already opening up there. So a lot of it is like, okay, value add in our sense. Flexible land ownership, right? So if you check, whenever you're buying property, right, and if you're buying property in a major area, so for instance, where we have Buckingham, one of our ownership properties, right, a land 600 is around 500 square meter, it's under 600, 500 square meter, you're buying it for 400 million for the land. as of 2026, 2026, 400 million, right? But if you want to go to Ibadan, right, you can get a land 500 square meter and you can pay between 1 million to 5 million, depending on what they want to do with that land, that location. We have a property in the same location, money here. One is going for 5-10 million, the other one is going for 1.2 million. And it's because those two estates have different strategies on how they want to implement the estates. One is focused on opportunistic land banking, one is focused on core plus. So when you start even applying these things to how you're thinking of real estate investing, you start seeing why certain projects are structured this way, certain investments are structured this way, right? And you start applying it to yourself as well to know which one works best for you. Abi, thumbs up if you are still with me. Hope I've not been speaking plenty grammar. Okay. Thank you. Okay. Here's the last slide. So, to summarize everything that we said today, right? There are 4 major types of risk when it comes to real estate investing. And this year, we want to really focus on how you can make your real estate investing more resilient. So as you're thinking of building, right? The way we've structured Keble is that we've created all of these avenues. I know someone that has played around all the investment categories. And I asked him the same question. Like, why are you touching co-ownership? Why are you touching land? Why are you touching investments and the likes? And the simple answer is like, it's diversifying, right? I know someone that invested in multiple co-ownership offers, right? And the simple answer is diversifying. And that's really the best way to build a resilient portfolio is that, okay, you identify what your risk appetite is, and you now start building investment portfolios. Investment portfolios. You start building your thesis, you start building the different investment that you have around your risk appetite. One important thing to note before I start answering questions is that your risk appetite changes. Yes, it does. Right? You see someone that has been a very conservative person before, right? All of a sudden, something happens in his life, right? He says, "Oh, I only live once, so this life is short," right? And he only focuses on pushing that. He goes into full-on value add and capital appreciation, opportunistic. So things can happen in your life that changes, right? And it's always that way. I take this thing at least twice. I take this what I call it. I take this the assessment twice in a year to just know, right? Has anything changed? Me, have I changed? And you'll be surprised. If you take it off, you see that it might not happen this year, it might happen next year. If we do this again next year, you'll be surprised that I've changed though. I'm now more opportunistic than before. What happened? Right? Or maybe this year showed you a lot of shaggy. So you move from opportunistic, you go to core. So nothing concerns you with opportunity again, nothing concerns you with Dangote refinery. You say, okay, I'm going to focus on core. Okay. So every given time you try to do a self-assessment to see how it works. And I think as you build that habit, as you build a portfolio that works for you, you become a more resilient real estate investor. Right. And I hope that this session was practical, was useful to you, right? And you can carry it throughout the year. And that's what we wanted to start this year with everybody. Know your own risk portfolio so that you're carrying it throughout the year into next year. You know that you're investing for yourself. I really appreciate everybody's time. I think I'll leave it to Debbie to help me with the questions. Thank you so much.
Thank you so much, Archifos, for breaking down that very, very clearly. I myself am a core plus investor. I just took the test today, and yeah, I'm super excited that I'm happy that I took the test. Now my real estate journey would be clearer. So quickly, because time is not on our side, we'll be taking questions. So while Chief Host was presenting, we had a couple of questions come in. You can put your questions in the chat box. I'll be reading from the first one that dropped. So from Uju Okonkwo, for the co-ownership shortlet, can the unit buyer sell off units eventually? What's the minimal holding period, and is there a lease term to owning? Also, can you buy more units from other co-owners if they are willing to sell? Over to you, our Chief Host.
Okay, so yes, you can sell off eventually. There is no minimal holding period. You can, the way co-ownership is structured, right? The principle behind it is that we wanted people to hold the assets for longer, right? Or as much as they want, right? So we are not going to impose any sell-off. However, we are going to introduce timelines that we are projecting or we are considering, or recommendations on our own side to say, hey, if you guys are willing to sell, we have a buyer that wants to buy it for X, right? And you guys can do your own voting to say, okay, based on this, I think this is a good time to buy, or this is a good time to sell. And I think we mentioned that if 70% of all unit holders agree to the sell-off, the sale would happen, right? If we don't get up to 70%, there's no point selling it. We keep holding it. You can decide to sell your individual units. That is fine. You can decide to sell it. The other thing to note is that if you want to buy off more units, which I foresee that would happen, the first right of refusal is to your co-owners. And the reason for that is easier to sell to your co-owners than to someone outside. So you can essentially say, hey, we've been making money from this, and maybe one person wants to make more money from the asset. He doesn't want to go too far off for any new investment. You're more likely to get your co-owners to own it than someone else, right? So the first person actually you introduce, would help introduce the asset to, is your co-owners. Then the second person is the general public, right? So I think that that answers your question.
Thank you. So the next question is, please, what's the landed property in Ibadan for a male?
Yeah, so we have Rockview, right? So we have, if you check the platform, we have a Rockview estate. Let me see if I can check the listings to see if that would help. Yeah, if I can do that real quick. Yeah. So yeah, so this is Rockview Estate, that's Ibadan as well. The total money is 1.2 million, right? That's for 300 square meter, and for 500 square meter is 1.7, right? So this is the price range. I think last year, if you plugged into it, you'll probably be paying in total around 1 million each, right? I think it's slightly increased to 1.2. There is another one that is the same location. Nothing changed, but I'll explain why the cost is different. This one. By the way, most of the properties are C of O, so that's where we play at. So you check here, same 300 square meter. What is the difference? Why is this one 8 million and the other one is 1.2 million? Why? The reason is, for Cardiff, construction starts, the estate development is limited, one. So there's not a lot of square meters. And the developer himself owns majority or some of the landed assets, and he wants to turn it into a resort. So right now, from Q2, you will start seeing that the developer is already constructing a resort-like feel around the estates, so that people can actually start booking and staying in these apartments. That is the focus. So it has moved from just opportunistic to value add, right? And there is a lot of value. Like these are two different assets, but they are performing two different functions. So when we're talking to customers about um, Cardiff, it's different from how we're pitching what do you call it? This other one, Rockview, right? Rockview is more of land banking. Like it's a promise of money as a destination hub, as a location to hold, right? So most people that have bought into Rockview, they're essentially owning it for long term, right? They want something, land that they'll probably have, they don't want any rush. They probably have, 5 years holding, they can sell it off. It's structured in that format, right? But for Cardiff, I'm pretty sure that construction will pretty much start in Q2. And the focus is more on like how do we make sure that people are already experiencing Cardiff in a new way, right? So yeah, I think that explains for that. That explains for that for you that if you're looking for landed properties and even how to look at those landed properties as you go along. Yeah. Next question, please.
All right. All right, so the last question in the chat box is, can a couple co-own a shared property? After that, Maxwell's hand is raised. We'll take Maxwell's question. So over to you.
Yes, we do have a couple currently owning a shared co-owned apartment, right? So they bought one slot. Now, what would happen is that it has to be in one person's account. However, in the documentation, because everybody that has that bought into any of the co-ownership, we give you a documentation, right? In that documentation, you would have your full name, not let me use my name, not Mr. and Mrs. Agulana. It's not Mr. and Mrs. Agulana. It is Mr. Michael Agulana and who is the other person? Let me use Debbie. Debbie Agulana. That is how it is structured. So that we know that both of you have joint custody to the property. Not that you wake up in the morning and we're not praying for the marriage to end, but we want to make sure that the documentation is clearly stating that these two individuals have come together to actually own this lot. And we have that same format for a group of individuals, a group of friends that are also buying into the co-ownership. It went through someone's, we call them principal, went through the principal's accounts, right? And they made payments. However, in the documentation, it had all the people's names that are involved. There are 3 people, 24, that are involved in the ownership of the property. So that is how it's structured at the moment. Debbie, is that fine?
All right. So we'll be taking question. I think we should take one more from the chat box before we move to the hands that were raised. So this person is asking, those Paul Ojela B, those properties on the Keble app, are they co-owned, or you must purchase a unit all by yourself? And buying a unit, is it a one-time purchase or monthly purchase?
Okay, great question. For land is not co-owned, so you can pay it off. For the co-ownership opportunities, most of the apartments are co-owned, but if you're interested in buying the full apartment, we can facilitate that for you as well. So whether you're interested in co-ownership or you want to buy it outright or you want to own it by yourself, those options do exist and people are inquiring for that. So we help them facilitate that. It's not a problem. The value add coming through Keble is just flexibility. So you do not have to pay all at once. You can spread that payment, right? And because maybe you're going through Keble and we've done business with all of these developers, they are willing to be a little bit more flexible, right? Say, okay, Keble is from Keble. So instead of doing 6 months, they can do 9. Or instead of doing 9 months, they can do 12, just because. right? So I think we've built that relationship to enable that happen. So yeah.
So we'll be taking 2 more questions and then we'll be rounding off our question Q&A sessions. So we'll be taking questions from Maxwell Raji. You can unmute and speak now. Thank you.
Hello. Hi. Yeah. My question is, when you on the Keble app, I'm not sure, can you hear me?
Yes, we can hear you, Maxwell.
On the Keble app, when you're trying to buy, you've got 2 options: one, buy outright, or pay monthly.
Yes.
So my question is, when you pay monthly, do the rentals come back to you, or do you have to pay it outright before you start getting your rentals?
Yeah. So I'm guessing you're talking about the co-ownership offering, right? And if you pay outright, when does rental start coming in compared to when you pay monthly? When does rental start coming in, right? Just checking. Great, fantastic. So for instance, we have 2 projects right now. I think we have Ibuduwura and we have Regal and we also have Nove. All of those projects, they should be completed this quarter, right? Payments are still rolling in at the moment, right? But I think by Q2, most of them would be fully paid off and rental income will start streaming in. Now, if you've not completed your payments by Q2, when all of these projects are done, right? Because most of them started off with construction. And I think if we've given an update to all the co-owners. If you've not completed your payments, you will not get any distribution, any rental income when rental income is settling, right? However, if you have even if it's a monthly payment, but at the point of when the property is ready and available for people to actually start renting it out, you will start getting it, right? So you have to have completed payments before or during the period where we are done when we are done with completion of the asset itself. So that's why the timeline essentially matches. I know people are still paying for Nove. Nove is completed. So at this point, it's waiting for the people to complete their payments so that we can kick things off. Similar to Riga. Riga is at roofing point at this point. I think we shared the updates with them. So it's just waiting for the project to be done and furnishing, and we are good to go. Right, so all of that should be settled by the end of Q1 going to Q2. So if you haven't finished making payments, even if we let it out, there's no need distributing income. However, if you've done, the income will be distributed appropriately. So yes.
Does that include the short lets as well?
Yes, yes.
All right. Cool. Thank you.
You're welcome.
All right. So our final question will be coming from Himen Abomian. You can unmute and speak now. Thank you.
Right. Good evening, Mr. Jose Maria. Thanks for the. I just needed some clarification. You talked about the Rockview estates, and you made mention of the fact that it was tilting towards the land banking idea, not really value added. But on the description on the property, I saw something talking about resort style. I think it was like being channeled to the other one you just opposed it with. That's the Cardiff as well as the one in Ido that has been sold out. So I just wanted to be very sure: is it that the resort style will still come on board after on, or is majorly a land backing thing? Because when I went through the description of it, it was more of a resort style. That was the description I got. So just wanted some clarification.
Good question. Thank you so much. So on the Rockview, right? Like I said, it's very opportunistic because what is driving people to Monia, whoever is building anything in Monia, is capitalizing on hospitality. So they are focused on, okay, this is a location that most people would prefer as a destination location in Ibadan, right? So anyone that is building that location is focused on that hospitality sense. So that's where you see the results. However, right, when is that hospitality coming up? It's not this year. Right, it's definitely not next year, right? So that is where the caveat is now. Is like, okay, it's not coming up this year, it's not coming up next year. that is where the land banking comes in. That the focus is that, okay, you hold it to, right? But the initial dream or the initial structure, the initial opportunity of why this place is important is for a resort style location, but it's not happening this year. However, in Cardiff, they would stop selling the estates by, I think, public sale on Keble will probably be open because we bought a couple of units, but public sale would close by the end of February. That means that even if you come with money, developer is not interested in selling, they will go into full construction, right? That is the slight difference because you know that, okay, within the medium to short to medium term time frame, there is some level of value add being created in these estates, right? And the goal is that for them to monetize it as quickly as possible, right? So I think those are the slight differences when you're looking at it. I hope that helps.
Okay. Yeah, it does. Thank you. Thank you.
Awesome.
All right, that would be the end of our question and answer session. I hope that we all learned a lot from today's session. So yeah, as we wrap up today's home circle, we'll be sharing helpful links in the chat box. So links to our social media pages so you can get updated on our property listings, new improvements, new updates about the real estate industry. So you can follow us on Instagram, TikTok, Twitter, YouTube. This particular home circle will be uploaded on our YouTube channel. So for replays and also to rewatch and everything. So you can follow us on our social media platform so as to get updated on everything real estate and also about to get updated about the next home circle event. All right, so yeah, since time is not on our side, we'll be ending this session now. It was lovely having all of you join this call this evening. Thank you so much for spending your evening with us. On behalf of the Keble team, we say a big thank you. And yeah, from today's test, if not everybody has taken the test, you should check the link in the chat box. The risk appetite portfolio test is there. Take it so you would know your risk appetite. That would really help you in your real estate journey in 2026. And like our chief host said, you can take it a couple of times, 3 months, 6 months. This month, you might be a core investor. Next month, you might be a core plus investor. Next 3 months, you might be a value add investor. And maybe in the next 6 months, you have the mind to chest a lot of risk. You can be an opportunistic investor. So basically, that's it. Thank you so much for joining. We hope to see you at the next home circle. And yeah, have a lovely evening and have happy new month in advance. Good night.